Here is a silent threat sitting inside almost every Medicare drug plan in the country, and most retirees do not see it until it has already bitten them. You pay your monthly Part D premium. You pay your copays. You take your medications faithfully. And then, one morning in late summer or early fall, you walk into your pharmacy, hand over your insurance card the way you always have, and the clerk looks up and says, "That will be $340 today." The same medication that cost you $12 in February is now suddenly more than $300. Nothing changed about the medicine. Nothing changed about your plan. What changed is that you crossed a threshold. The industry quietly calls the coverage gap, and it is the single most misunderstood feature of Medicare Part D. This year, that threshold sits at approximately $5,030 in total prescription drug spending. That is not what you paid out of pocket. That is the combined total of what you paid and what your plan paid. Most retirees have no idea how close they are to that line, because the summary of benefits their plan sent them in October of the previous year uses language that requires a dictionary to decode. Today, I am going to explain exactly how the coverage gap works, how the recent law changes are reshaping it, and how to protect yourself from the shock most retirees feel every fall. Let me also give you the disclosure I always include. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. Medicare rules change frequently. Drug pricing is highly specific to each plan and pharmacy, and your personal situation deserves a tailored conversation with a licensed Medicare advisor or State Health Insurance Assistance Program, known as SHIP counselor. To understand the coverage gap, you have to understand the 4 phases of a traditional Part D plan. Phase 1 is the deductible. Most plans have a deductible, which can be anywhere from 0 to the maximum allowed under current law. You pay full price for your drugs until you meet this deductible. Phase 2 is the initial coverage phase. In this phase, you pay a copay or coinsurance, and your plan pays the rest. Your total spending, which means what you paid plus what the plan paid, accumulates until you hit the initial coverage limit. That limit is where the coverage gap historically began. Phase 3 is the coverage gap itself, sometimes called the donut hole, where the cost structure shifts. And Phase 4 is the catastrophic coverage phase, where your out-of-pocket costs drop significantly. Here is the change that is reshaping all of this. The Inflation Reduction Act made significant changes to Part D that are being phased in. Beginning in 2025, there is a hard out-of-pocket cap of $2,000 per year for Part D covered drugs. This is an enormous change. Before this cap, retirees with expensive medications could face thousands of dollars in out-of-pocket costs, even after reaching catastrophic coverage, because there was a 5% coinsurance in that phase. The $2,000 cap eliminates that exposure. The coverage gap phase is also being restructured as part of this transition. What does not change is the need to understand your own plan's specific cost structure, because every plan has different formularies, different preferred pharmacies, different tiers, and different negotiated prices. Let me translate this into real dollars with a story. Ruth, a retired elementary school teacher from rural Iowa, was 81 years old and taking 4 medications. 2 were generic and inexpensive. 2 were brand-name specialty drugs for a chronic condition. In January, her copays totaled about $45 per month. By July, her pharmacy started charging her $170 for one of the brand-name drugs. By October, it was over $300. Ruth was living on about $2,300 a month between Social Security and a small pension. $300 out of a $2,300 monthly income is 14% of her income going to one medication. She considered skipping doses. She considered splitting pills, which her doctor later told her she absolutely should not do for that particular medication. She was scared and ashamed to ask for help. Eventually, her daughter brought her to a SHIP counselor, who walked her through the coverage gap, helped her apply for extra help through Social Security, and switched her plan during open enrollment to one better suited to her specific drug list. Her total prescription costs for the following year dropped by roughly $1,800. Let me walk through the major programs and tools every Medicare beneficiary should know about. The first is the Extra Help Program, also called the Low Income Subsidy. If your income and resources are below certain thresholds, Extra Help pays most of your Part D costs, including premiums, deductibles, and copays. The income limit has recently been expanded under federal law, meaning more retirees qualify than in previous years. For many beneficiaries, Extra Help can mean the difference between $4,000 a year in prescription costs and under $500. Applying is free, and you can apply through the Social Security Administration online, by phone, or on paper using Form SSA 1020. If you have been denied before, it is worth reapplying because the eligibility criteria have changed. The second is the annual open enrollment period, which runs from October 15th to December 7th each year. This is the one time you can switch Part D plans without qualifying events. Every September, your current plan sends you an annual notice of change, often abbreviated ANOC, which explains changes to premiums, formularies, preferred pharmacies, and copays for the following year. Most retirees file this letter without reading it. Read it, every word. Because the plan that was best for you this year may be terrible for you next year, and open enrollment is your only regular chance to switch. The third is the Medicare Plan Finder tool on Medicare.gov. If you enter your specific medications, your preferred pharmacy, and your zip code, the tool shows you every Part D plan available and estimates your total annual cost under each. Most retirees have never used this tool. It is free. It takes about 30 minutes to use properly, and it often reveals that a different plan would save you hundreds, sometimes thousands of dollars over the year, based on your specific drug list. You do not need permission to use it. You do not need to enroll through it. You just need to compare. The fourth is the Medicare Prescription Payment Plan, which is new and rolling out nationwide. This program allows you to spread your out-of-pocket prescription costs across monthly payments rather than paying large amounts at the pharmacy counter. It does not reduce your total cost, but it smooths the cash flow, which is enormously valuable for retirees on fixed incomes. Ask your plan about enrolling. Not every retiree benefits from this, especially if you prefer to pay as you go, but for those facing big front-loaded expenses, it can be a lifeline. Let me introduce you to Frank. Frank was a retired railroad machinist from Pennsylvania, age 76, living with his wife on a combined income of about $51,000 a year. He took one specialty drug for a blood disorder that had a list price of over $4,000 per month. In earlier years, Frank had paid many thousands out of pocket for this drug. Once the $2,000 out-of-pocket cap took effect, his exposure on Part D, covered drugs, was capped. He still paid his premium. He still paid copays in the early phases. But once his out-of-pocket total reached $2,000, his further spending on covered drugs for the year was effectively zero under the cap. That is a fundamental change from the old system. Frank's annual prescription spending dropped by roughly $6,000. Now, let me walk through the traps. Trap number 1. Not all drugs count toward the cap, or even toward your Part D coverage. Some medications are covered under Part B instead of Part D, particularly certain injectables administered in a doctor's office and some cancer drugs. Part B has its own coinsurance structure, and the Part D cap does not apply to Part B drugs. If you take injectables, ask your doctor and your Medicare plan which drugs fall under which part. Getting surprised by a Part B coinsurance bill after thinking everything was capped under Part D is a painful and common experience. Trap number 2. Formulary changes. Every plan publishes a formulary, which is the list of drugs it covers and at what tier. Plans can change their formularies during the year with proper notice. A drug that was Tier 2 in January could move to Tier 4 in June, which can raise your copay dramatically. If you receive a notice about a formulary change, act quickly. You may be able to request a formulary exception, file an appeal, or work with your doctor to switch to a comparable drug still on the preferred tier. Do not ignore these notices. They often arrive looking like junk mail. Trap number 3. Preferred pharmacies. Many Part D plans have preferred pharmacies where your copays are lower than at standard network pharmacies. If your neighborhood pharmacy is not preferred, you may be paying more than you have to. Use the Medicare Plan Finder or call your plan to identify preferred pharmacies in your area. Mail order pharmacies are often preferred and can offer 90-day supplies at lower effective cost. Trap number 4. Failing to use the coverage determination process. If your drug is not on your plan's formulary, or if the tier is too high, you can request a formulary exception or a tiering exception. Your doctor submits a statement explaining why you need the specific drug. If approved, the drug becomes covered at a more favorable tier for you specifically. This process is underused because most retirees do not know it exists. Your doctor's office can help you file the request. Follow up in writing. Keep copies. Trap number 5. The IRMAA surcharge on Part D premiums. In addition to the IRMAA surcharges on Part B, Part D also has its own IRMAA surcharge for higher income beneficiaries. For a single filer, if your modified adjusted gross income exceeds $103,000, you pay more for your Part D premium on top of whatever the plan's base premium is. For a married couple filing jointly, the threshold is about $206,000. The surcharge is based on your income from 2 years ago. If your income was unusually high in that prior year due to a one-time event, such as a Roth conversion or the sale of a home, you can file Form SSA 44 to request that the Social Security Administration use a more recent tax year. Most retirees do not know this form exists. It can reduce your IRMAA for the current year substantially if a life-changing event applies, such as retirement itself, reduction in work hours, death of a spouse, divorce, or certain other specified events. Let me tell you about Eleanor. Eleanor was a retired hospital administrator from Nevada, age 70, who sold her late mother's home in 2022 and realized a large capital gain that pushed her modified adjusted gross income well over the second IRMAA tier. Her 2024 Medicare premiums, based on that 2022 income, were significantly higher than they otherwise would have been. When she mentioned it to her accountant in February, he asked whether the income was from a one-time event. She said yes. He showed her Form SSA 44 under the category of loss of income-producing property and helped her file a request to use her 2024 income instead, which was back to normal retirement income levels. Her Part B and Part D premiums were adjusted downward for the year, saving her roughly $2,200 over 12 months. I want to also mention Medicare savings programs, which are state-administered programs that help with Medicare costs for beneficiaries below certain income and resource limits. These programs can pay your Part B premium, and sometimes Part A premium, deductibles, and coinsurance. The names vary by state. Qualified Medicare beneficiary, specified low-income Medicare beneficiary, and qualifying individual are the 3 main categories. Eligibility is handled through your state Medicaid office, not through Medicare directly. If your income is modest and you are paying for Medicare Part B premiums out of pocket, it is worth checking whether you qualify. Here is an important integration point. If you qualify for Medicare savings programs, you automatically qualify for extra help on Part D. That means the application process for Part D help is often easier if you are already in a Medicare savings program. Many retirees qualify for both, but have only signed up for one. Ask your SHIP counselor for a comprehensive eligibility review. Let me also talk briefly about manufacturer patient assistance programs. Many drug manufacturers offer programs that provide free or deeply discounted medications to patients who meet income criteria. These programs are separate from Medicare. They often require your doctor to complete paperwork. They can reduce or eliminate your cost for a specific expensive drug even if Medicare would not cover it, or if the copay is unaffordable. A website called needymeds.org keeps a database of these programs organized by drug name. Check there if you are taking an expensive medication. One practical tip: before filling any expensive prescription, ask your pharmacist to run it under your Medicare Part D plan, and also to show you the cash price. In certain situations, particularly for drugs on discount programs, paying cash is cheaper than going through your insurance. This is counterintuitive but true. Your pharmacist cannot volunteer this information in some states due to gag clauses that were once common, though many of those clauses have been overturned. Ask specifically. The phrase, "Can you tell me the best price?" For this drug across all payment options usually gets you the answer. A word on specialty drugs. Some medications are classified as specialty drugs, typically those with a cost above a specific threshold per month. Specialty drugs are placed in a separate tier with a coinsurance structure rather than a flat copay. Coinsurance, meaning a percentage of the drug's cost, can create enormous variability. Even under the new $2,000 cap, reaching the cap with a specialty drug can mean paying $1,000 a month for the first 2 months of the year, then nothing further. The Medicare prescription payment plan can help smooth these costs, as I mentioned earlier. Let me give you a quick action checklist for every Medicare beneficiary. First, pull out your most recent annual notice of change letter and read it. If you no longer have it, call your plan and request a copy. Know your premium, deductible, formulary tiers, and preferred pharmacies for the current year. Second, log into Medicare.gov or create an account. Use the Plan Finder tool. Enter your medications, compare plans. Do this every single year during open enrollment between October 15th and December 7th. Most retirees who do this at least once find a better plan they never knew existed. Third, apply for extra help if there is any chance you qualify. The thresholds have expanded and application is free. Go through Social Security. Fourth, ask your SHIP counselor about state-specific Medicare savings programs. These programs vary widely by state and can significantly reduce your total out-of-pocket costs. Fifth, if your income was unusually high in a prior year due to a one-time event, file Form SSA 44 to request an IRMA adjustment. Do not let a one-time spike permanently distort your Medicare premiums. Sixth, keep a running list of every medication you take, including dose, frequency, and current pharmacy price. Review this list annually with both your doctor and your pharmacist to identify any cost reduction opportunities, including generic switches, combination pills, and manufacturer assistance programs. Seventh, never skip doses because of cost without talking to your doctor first. Many health crises in retirement trace back to medication non-adherence driven by cost. There are almost always assistance options available. Speak up. Ask for help. Your doctor, your pharmacist, and SHIP counselors are all resources. The coverage gap is not what it used to be. The $2,000 out-of-pocket cap has fundamentally changed the math for retirees with expensive prescriptions. But the plans are still complex, the formularies still change, and the help still has to be claimed. Nobody will do it for you automatically. Every retiree who wants to protect their prescription drug costs needs to be an active participant in their own plan choice each year. If this video helped you understand your Part D plan better, I want to ask a favor. Please share it with one neighbor or family member over 65. Most of what I explained is not a secret, but it is buried in documents that nobody reads. By sharing this, you help someone you care about save real money. Subscribe to the channel for more videos that walk through one specific rule at a time, in plain English, with concrete numbers. Turn on notifications so the next one reaches you. And leave a comment below telling me what your biggest prescription cost question is, because your questions often become the next video. I will see you then.